Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We're going through, over the past couple weeks, this new tax reform proposed by the Trump administration to try to change and make more progressive, supposedly, the tax system, and also for tax simplification. So last week, I started going through some of the details, sharing some of the tax advantages and tax planning opportunities we need to start being aware of now before year end on tax benefits that we might lose, and also recognize some benefits we might gain that we don't currently enjoy, so we might want to wait to take advantage of. So I'm going to continue with that discussion with another portion of the proposal, which is referred to as our standard deductions versus our itemized deductions discussion, and what we might lose and gain through this proposal. So here goes. What we have to do is we look at itemized deductions today. It's said that about 70% of the people, I think it's 71%, use the standard deduction, because the way taxes work right now, we all have a choice whether we want to itemize deductions, in other words, add up all of the things we do throughout the year that are tax deductible activities, and see if all of those activities and expenses add up to more than a standard deduction the government gives us automatically for not doing anything. So right now we might have $12,000 standard deduction, and for a married couple, let's say. And we might say, well, what are the deductible items that I'm spending money on anyway? Medical expenses. I had a lot of medical expenses this past year, we might say. Oh, they're deductible from our taxes? Maybe. Home interest, home mortgage interest, property taxes, charitable donations. So we add all that up and we say, wait a minute, that's a lot of money. Let's add all that up and see, do those expenses exceed the $12,000, let's say, automatic deduction the government gives us? And sometimes we'll add up all those itemized deductions. We look at the tables, what's all allowed to be deducted? We add everything up, school supplies for a school teacher, all those things that we don't even know to think about. And we go look at the charts and say, what are all the deductions that are able to be itemized? We add up all our expenses for the whole year, donations to Goodwill and clothes and everything, and we add church, and we add everything up and we say, oh my goodness, we've spent $18,000 this past year on things that are allowed to be itemized, and the government gives us an automatic $12,000 if we don't itemize. So let's list them all out. That's called itemizing our deductions, and take a tax deduction for all of those things that we spent. The government allows us to itemize. Well, statistics are showing about 71% of households are using standard deductions today. Only about 29% are able to actually itemize where their expenses they're actually paying exceed the standard deductions. All right. The reason I wanted to go through that is there's some pretty major changes being proposed under this rule, under this new tax reform. So here we go. The write-off for state and local income taxes. That is referred to by an acronym as SALT, S-A-L-T, state and local taxes. Well, you say, that's not really any big deal. Well, it might be. Right now, one of the potential deductions, itemized deductions, is a deduction for what you've paid on your state income taxes and local. But guess what? all of that also includes property taxes. So when they say state and local taxes, they mean property taxes too. Now that's a whopping amount for a lot of people. That might be the first $4,000 or $5,000 or $6,000 already of what you're spending just on property taxes, or way more. That's a big one. Another one is home interest. So one of the discussions were, are they going to get rid of the home interest deductions? Are they going to get rid of the real estate property tax deductions? Well, here's what it looks like. They proposed the write-off for state and local taxes, including property taxes, might be abolished, might be gone. And the only deductions as itemized deductions that might be saved are home interest and charitable deductions. So the National Board of Realtors, they're all up in arms over this, saying, wait a minute, if you're doing only standard deductions, people can only take home interest, but they cannot take the property taxes and all, then in essence, by doing a standard deduction's almost always going to now exceed itemizing. So now that home mortgage interest, even though it's deductible, nobody will be paying enough to exceed the new standard deduction. So it's a moot deductible expense. And people won't want to go out and buy homes now because the attractiveness of that it's a deductible expense for the interest, even though by definition it is, they'll never get over their standard deduction, so it's of no use to these home buyers, and it'll depress home sales. So you see how these seemingly unrelated deductions they think might curtail home expenses, home purchases rather. All right. Now, we look at the home interest rate, and then we look at, can the congressmen, senators, and even everybody in government agree on anything? So not to get totally up in arms about will this thing even pass, but because it's year end, I'm putting more attention on it than usual. So if this was proposed in March, I probably might not even really be talking about it because I'd wait. You know, a lot of these things that are proposed never even get passed. But because we're in fourth quarter, it's important. First off, what if it does go into place next year? What might we lose this year we want to take advantage of? So we might want to prepay medical expenses, prepay taxes, prepay this, prepay that, right? To build up, specifically identified expenses because we know they're tax deductible this year. And maybe next year we'll take the standard deduction because we paid all our expenses year end this year. We accelerated all our expenses, right? So that's why I'm devoting so much attention to that now in fourth quarter because of this proposal. Now, let's look at another thing. This 25% for pass-throughs for corporations, we're looking at a 35% maximum bracket for individuals, remember? So I said 3 new brackets last week I told you about. 15%, 25%, 35%. So again, we have a high net worth person, 35% income tax for their personal income, which might be generated from a business, and it might not be, but they might not be incorporated, let's say. Then is the risk that they might incorporate in a pass-through corporation because that maximum tax rate will now only be 25%. Well, sure, there's a risk of that. The IRS and the congressmen have said, yes, the government's saying, we don't want abuse of this, where we as consumers say, hey, we have an opportunity to reduce our taxes by diverting how we earn that. So it's going to be a cat and mouse game. So keep aware on that one. Be aware on the corporate rate, the flow-through rate, and the individual tax rates, and do some tax analysis and planning on this year's rule as we know it now under today's tax code versus the proposed, and are there things we should do this year to take advantage of that we might lose? That makes sense. Now, the gift tax, that is something that we've actually run into in the estate tax discussion. So it's proposed that if the government repeals federal estate tax, like I talked about last week, would there still be a gift tax? Because it's been the federal estate and gift tax. So now if they get rid of the estate tax, does that mean they also get rid of the gift tax? The way this is proposed, this tax reform right now, is that they'll keep the gift tax. Again, probably everything's going to change. So what we're still looking at is the risk of, if we gift money as a taxable, might still be a valid question. Whereas if they repeal the estate tax, we might be saying if we die with a major estate, is that federal estate taxable? That might go away, let's say. But if we gift it prior to death, is that still subject to a federal gift tax? Looks like that may still stay in place. And if it does, then are we still also limited to no more than $14,000 annual gifting to any other individual without being subject to having to file a gift tax return? So stay tuned to see what happens there. But right now it looks like the federal gift tax code looks like it's going to stay in place, net gift tax. Now, any victims of hurricanes, there's a hurricane relief provision in today's tax code. Most people are unaware of that. So if either you or someone you know has been affected, pay close attention here. I know a lot of people have properties down there, or relatives. Pay close attention. These benefits are highly, highly lucrative and flexible. Do not miss these. Here's what they are. Victims of Hurricane Harvey, Irma, and Maria. They have defined the ones that you get relief from. Get relief from Congress. Here's what they could do. They could take, well, first, we've always been able to do this, but the limits are higher. They could take casualty losses from storm damage, even if they don't itemize. Now, casualty losses are typically for what you are not reimbursed for. You could take a deduction on your income tax return. So you have damage, and the insurance company didn't pay. So you have to pay yourself. We've always been allowed to take casualty losses, but not in excess of certain limits. Well, now we're able to take casualty, and you had to itemize. So remember when I got through that discussion on standard deductions versus itemizing? Well, you had to itemize because it was one of the itemized expenses as opposed to the standard deductions. Here now, you could take the standard deduction and still, if it's one of these three hurricanes, take a casualty loss deduction in addition, even if you don't itemize. So that's why I said pay attention here. You're able to deduct uninsured personal losses in excess of $500 threshold without regard to the 10% of the adjusted gross income offset that normally applied to the deduction. You don't need to know all those details. All you need to know is these deductions are expanded for casualty losses. So when you're paying for things, keep those receipts. Don't think, oh, well, it doesn't matter, I'm on my own. Keep those receipts. We're looking at tax benefits here to help you recoup at least some of those expenses that you're not able to itemize, or even if you are, they're not high enough to exceed your standard deduction. Now listen, 2016 income. So we're in 2017, and we use 2017's income to calculate all of these, what percentage of adjusted gross income it's all this year's calculations. What they're saying for this hurricane relief is you can use 2016's income to use to figure the earned income tax credit. Here's why they're saying this. A lot of people that are in those hurricane affected areas are missing a lot of work. Their incomes are going to be way down. The earned income credit is based on income. So if your normal income is $48,000 a year or $28,000 a year or whatever it is, this year you might only have half of that or 2/3 of that or whatever because you're taking so much time away getting your house in order, getting things done. And it's affecting your taxes because now this year, your income is so much lower that you took. And that means every other factor on your tax return is based on so much lower of an income, including your earned income credit. So the government said, we're going to let you take your earned income credit still based on your prior year's income when it was a full year's income, not this handicapped year and a handicapped income. So they're allowing you to take the full earned income credit, even though you're not earning full income this year. That is big. And it credits cash to you. That's not a deduction. That's a big one. Now, same thing for the child tax credit. So we have a child tax credit, and that's based on income. So are all these IRA contributions and everything else I talk about based on income. So your income may have always been, let's talk about this, too high to contribute to a Roth IRA. Year after year after year, you've wanted to contribute to a Roth IRA. You've not been able to do so because your incomes are so high. If you're affected by the hurricanes this year, if your income's lower, you might be able to now qualify for a not tax deductible contribution to a Roth IRA, but a contribution to a Roth IRA, which you've never been able to do before, and get into a Roth IRA for future tax-free growth. So think about that, because there might be an opportunity here that you could take advantage of due to the hurricane and depressed earnings that you have this year. So there are different changes this year that you have to be aware of, and they're one-time changes. All right, now, here's another one. We look at a 10%, remember the pre-59.5 penalty from IRAs? So if you have a traditional IRA, or actually a Roth IRA, and you pull money from that prior to you're attaining the age 59.5, you not only pay taxes on the IRA, if it's your traditional IRA, on whatever portion you pulled out, or taxes on the gains from a Roth IRA if you pull it out prior to age 59.5. And in addition, because you pay the tax anyway, even if you're over 59.5 on a traditional IRA. If you're over 59.5 on a Roth, it's totally tax-free. Under 59.5 on a Roth, you pay tax on the gain in the Roth, and both the traditional IRA and or the Roth are subject to an additional 10% penalty. In the Roth, it's 10% penalty on the gain portion, in addition to paying the tax, which would have been tax-free. And in the traditional IRA, it's 10% of what already would have been the taxable portion that you pulled out. So it's not 10% penalty on the whole IRA, it's what you pull out. Well, guess what? Hurricane relief says the 10% penalty on pre-59.5 payouts from retirement accounts is waived. That's pretty big. So for those who need relief and looking for funds to make repairs due to hurricane relief, your 10% pre-59.5 penalties are waived if you're in those areas that were affected and you need those. And here's what it says: as long as the IRA or retirement plan withdrawals are not greater than $100,000. So you can withdraw up to $100,000 from a traditional IRA prior to age 59.5 and not incur the pre-59.5 10% penalty. That's big. If you're going to have to take the money out anyway because you have nowhere else to go to get the money, that's a government helping you at least to not have to pay a penalty because you needed it prematurely. Also, they've passed, these are in force right now, these provisions. The income tax on those distributions can be spread over a 3-year period instead of being paid all at once in the tax year you take those withdrawals, where normally they'd be taxed right when you take the withdrawals. So that's an important one. So for those of you affected in that area, or for those of you who have people or relatives or friends or family that you know are affected down there, have them email us, or email us and have us email a copy of this show, which we do. Anyone who calls or shoots us an email, we'll add you onto the list. I video these shows, as you know, that we put on the TV, and I audio record them that go onto the radio, and you can have a copy of the shows. So just email us, we'll put you on the list. I send that out every week to our subscribers. So I'll be happy to do that, and they can listen to this show and say, hey, there's hurricane relief. Listen through some of these topics because they can benefit them. All right, now, so we spread out the income tax every 3-year period. Now, amounts recontributed to the plan or IRA during that span will be the 3-year span will be treated as rollovers. Is that amazing? Did any of you even know about this? That's why you need to tune into the show. I'm researching this stuff all the time. But you look at that and you say, what? So I need the money now, but I'd like to replace it. But I can't replace it within 60 days, the normal rollover period. I need this for a year or a year and a half or so. Well, what it says is amounts recontributed to the plan or IRA during that span will be treated as rollovers, and it gets better. Tax paid on those amounts can be recovered by filing an amended 1040. So there are opportunities not to be missed if you're forced to tap into your IRAs for repair costs due to Harvey, Irma, and Maria. You're getting relief from Congress. This is a little known, almost silently passed relief bill, I guess I should call it, or provisions that a lot of people are going to miss out on because they're not aware of it. And the worst part is they're going to take distributions from these IRAs, and they're not going to know. And they're going to file their own taxes or TurboTax or go to somebody or go to the senior centers, whoever, or do your taxes yourself, and they're not going to know, and they're going to pay the tax. The IRS is not going to call you after you send your tax return in April or May or June next year and say, hey, by the way, you took $100,000 out on an IRA and you don't owe the tax, or the penalty rather. And did you know you could put it back in within a period of time and get that tax back? They don't even know that you took it out for Harvey or whatever. So knowledge is power, and lack of knowledge or ignorance is extremely expensive because you don't know what you don't know. All right, now, victims can borrow more from company retirement plans such as 401ks. So you know under the borrowing rules on 401ks, if the 401k plan even allows borrowing. So you have to contact your 401k provider and you have to ask, is borrowing even allowed on these plans? Because some people say, I want to make a withdrawal from my 401k to do repairs for the hurricanes, let's say. Not even realizing, oh, wait a minute, I could have taken the money out as an in-service distribution, but I could also borrow the money out with an intent to repay, and that is correct. So you could borrow, and it says victims of these hurricanes can borrow more from company retirement plans than typical. Typically, you're allowed to borrow under most plans up to 50% of what's in the plan, and normally have a repayment schedule of over about a 5-year repayment schedule at a declared interest rate on those funds. But here, victims of Harvey, Irma, and Maria can borrow more from company retirement plans up to the lesser of $100,000 or 100% of the account. So if you have $1 million account, you can only take $100,000 out. Borrow that under this provision for this exemption. But you've always been able to borrow 50% out, so you can do that. But under this provision, to get the excess out, they're saying the lesser of, to get this benefit, 100,000 or 100% of the account. So if it exceeds more than 50% is where this rule will apply. So if I have an $80,000 401k, I could borrow the whole 80,000 is what they're trying to say. Now, we have charitable contributions, but if you're in a hurricane-affected area, no longer the case temporarily. The 50% of adjusted gross income limitation does not apply. So we're only allowed to contribute up to so much for charitable deductions, and that's always been the case. But anyone in the areas that are victims of Hurricane Harvey, Irma, and Maria, the 50% of AGI limitation on charitable contributions is suspended for any cash donations to qualified charities that aid victims of Harvey, Irma, and Maria. So if you want to donate cash and you say, I'm not in the area, but I want to donate cash to the victims of Harvey, Irma, and Maria, but I'm only allowed to deduct, you're allowed to gift whatever you want, but I'm only allowed to deduct cash up to 50% of AGI. That limit is suspended right now for contributing cash to aiding victims of Harvey, Irma, and Maria. So that's a biggie. And corporations can fully deduct cash donations for hurricane relief. They haven't been able to do that. The usual 10% of taxable income limit usually applied. It doesn't apply for this one for the hurricane victims for hurricane relief. So corporations, pay attention to this. You have an opportunity to help donate and contribute charitable donations for hurricane relief and take fuller tax deductions than you're normally able to take. There's also a special break for hurricane-affected firms. That's firms in the areas of hurricane areas. And for those hurricane-affected firms, some choose to keep paying workers, even though the business operations are suspended. So there's a special break for those companies. And they get a 40% tax credit up to $6,000 of wages paid to each idle employee. Now, firms that are doing this, listen carefully. You probably already know this because I'm assuming you have a good tax representative or tax team on staff. But I said a 40% tax credit for up to $6,000 of wages paid. Remember, that's not tax deduction. A tax credit is money back. A tax deduction is just deduction is just a reduction from your income that you're able to take a tax deduction for. A tax credit is cash. So when you say up to $6,000 of wages paid for each employee, and you get a 40% tax credit for that, that means a $2,400 check, not a $2,400 deduction. That is huge. If you're in a, tax bracket that these firms are already paying down there, especially small firms who might not be aware of this credit, don't miss that credit. It's big. All right, we're out of time today, and I appreciate your tuning in. Again, subscribe to our email list. We'll send you information and get you on our email list to get copies of the shows and all, to share with anyone who isn't knowledgeable about the show or hasn't tuned in or is out of the area or whatever. The radio's online, and it broadcasts live all around the country, actually, through the internet. You can access that through wwnl.com, and you can access us by just emailing us and contacting us, and we'll get you on the list. You can get hard copies of the shows. We'll send them out to you. But I'm doing these shows to try to benefit as many people as I can find that need the help. All right, we're out of time. I'll be back again next week.